Term, universal, and whole life. What's the difference? And does it matter? Brought to you by SCFSIC. Aloha, I'm Stan Cox, Principal Strategist and Broker with SC Finance Strategies and Insurance Consultants. This isn't so much a frequently asked question, but it should be, because it's really one of the least understood in the world of life insurance. The question is, what is the difference between term, universal, and whole life insurance? Well, we're going to answer that question today real simply. There are three basic types of life insurance: term, universal or variable, and whole life. There's really only one commonality between the three. They will all pay a predetermined monetary benefit to the designated beneficiaries upon the death of the insured. Universal and whole life have a couple additional similarities. I say similarities because they're not the same, although the terms used are the same. Both are considered permanent and both are called cash value life insurance. The similarities end there. First, let's consider term insurance because it's the simplest. Then I'll come back to the comparison between universal and whole life. Term insurance is very much like leasing. You never own it. That is, just like when you rent your home, you never acquire equity or ownership in it. And when your lease is up, you have to renew it or move out. With term insurance, you're leasing a cash benefit. The sole purpose of term insurance is to provide a cash benefit to the beneficiary you name if you should die during the lease term. You pay a premium for that benefit, and it's at a reduced rate compared to universal or whole life. But that's all that type of insurance is good for. When the lease term is up, the insurance terminates. There's no value whatsoever left over. You don't get a rebate for not dying during the term. And if you want to renew your lease, you have to pay a much higher rent premium for the next lease term. Term insurance policies are typically for 10, 20, or 30-year terms, or lease periods. And here's a little secret that most people aren't aware of. More than 98% of all term policies terminate before the insured person dies. What does that mean? It means that 98% of term policy benefits are never paid to the beneficiaries. There's a good reason for that. You see, insurance companies have people called actuaries. And what they do is they crunch all the numbers. I mean all the numbers, all the known facts. And they determine from historical data how long a person is likely going to live. So when you apply for a term policy and the actuarial data indicates that you're not likely to live another 20 or 30 years, you will not be approved for a policy with a 20 or 30-year term. It's as simple as that. It's like the insurance companies stack the deck in their own favor. They definitely do not want to pay out a death benefit on a term policy. They don't make enough money from the premiums to cover it. So term policies are actually very profitable for insurance companies. And I should mention here that the reason the cost of insurance goes up so much when renewing a term policy is because of the end of the term you just finished. You'll now be 10, 20, or 30 years closer to the likelihood that you will die during the next lease period or term. The principle is also the reason, or this same principle is also the reason the cost of insurance or premium is higher regardless of the type of insurance the older you are when you purchase the policy. Now let's talk a little bit about universal life insurance. There are three types of universal life: GUL, which is guaranteed universal, IUL, which is indexed universal, and VUL, or variable universal life. First, universal life is built on a term policy. That is, the basic policy is a term policy that has a separate savings investing feature. So right away, you should figure that if it's basically a term policy, it isn't actually permanent. It can be, but it certainly isn't guaranteed to be permanent. Often, GULs are sold as permanent cash value insurance, and that the premium is set and won't increase. Universal insurance is also called variable premium insurance because you can vary the amount you pay in premium. However, if you don't pay at least the minimum amount of premium to cover the cost of insurance, plus the management fees, the policy will lapse. The cost of insurance is continuously increasing, just the same as with term policies. So if you don't voluntarily increase your premium over time, either any cash value that has accumulated will get used up, or the policy will lapse, or most likely both of those things will happen. Because of the structure of universal life policies, unless you intentionally overfund or overpay the premiums, they typically don't begin to accumulate any cash value for about 8 years. And the insurance company can increase the management fees anytime they decide to. About the savings investment part of GULs. A portion of your premium is usually invested in bonds, so the gains are very conservative. And again, there's the fees, which can eat up a good part of any gains. As a result, cash value is very slow in coming. IULs have their saving investment portion linked to a particular stock market index, such as the S&P 500. However, while they are linked to the index, they usually have a cap to how much of a gain in cash value they are allowed to acquire. For instance, a policy may have a cap of 12%. Therefore, if the index climbs to a gain of 15 or 20%, your gains are going to be limited to 12%. And that sounds pretty darn good. But before you get anything, management and administration fees will be deducted. And so after all of that, you might realize about a 6% gain. Most IULs do have what is called a floor, usually 0%. And what that means is that if the index goes negative, loses money, it won't affect your cash value. You won't gain anything, but you won't lose anything either. Variable or VUL policies have their savings investment portion invested directly into stocks or mutual funds. These are actual investment products with term life attached. So in the case of variable universal life, VUL, there may not be a cap to gains, but there's also no protective floor. So if your investments tank, you definitely can lose money in your policy. Now let's talk about whole life. Whole life is truly a permanent cash value insurance. The premiums are guaranteed to be level and not go up over time. The cost of insurance is locked in at the start of the policy, so the premium won't increase. There really aren't any fees with whole life insurance other than statement fees if you pay your premiums more frequently than annually, like monthly, quarterly, and so forth. Typically, cash value begins to accumulate in just the 3rd year of the policy, not like universal in the 8th year and so forth. and it is guaranteed a minimum annual interest rate, and it's a compounding interest. There are design options with most insurance providers that can raise the benefit value inexpensively, increase the cash value accumulation faster, include long-term care, and so forth. As long as you meet the required premiums, the policy will never lapse. The cash value will continue to grow, compounding, and the benefit amount will also continue to grow as well in most cases if the policy is with a mutual company and it's a participating policy. In other words, it participates in the dividends. Whole life can be designed as an investment, as a variable whole life. As with any other investment products, these are subject to the risk of losses. Losses can affect both the cash value and the death benefit. In my opinion, investments and life insurance should be kept separate. Whole life living contracts with a mutual company can be a tremendous financing tool with which you can create the most versatile and powerful personal financing system there is. We call that strategy the tax-free cash growth warehouse. Term and IU or universal life products are not useful for that at all. So if you'd like to learn more about the tax-free cash growth warehouse strategy and how that works and everything about it, please click on the link right below this video. Become master of your financial world. It's a 60-minute free webinar. You'll learn all about the tax-free cash growth warehouse strategy. And please, subscribe to this channel and you'll be notified whenever we add additional answers to frequently asked questions or other content.